So I think y'all are all set, all comfortable.
Right. Yeah, awesome. Thank you.
Alrighty.
We're on in 5 minutes or so.
Yes, sir.
Right. Yeah. Oh, sure. Yep. Yeah. I'll try to have him come up. Well, good morning, everyone. Everyone can hear me all right? No, you go. Now you can. I'm going to ask that again. Can you hear me okay? All right. Well, it's nice to see a lot of familiar faces out there. So welcome, everyone, to what is most assuredly the most exciting panel of all biogas and RNG. And so we have a great topic for you today with some really terrific presenters. I'm your host, moderator, Todd Taylor from Avisen Legal. Been a member of ABC for a long time, do project development and project finance for biogas and RNG. By the way, if you have a cell phone and it rings, then you got to buy beer for everybody. So just make sure your phones are on silent and we'll go from there. So this panel, is terrific, and I'm so proud and honored to be moderating this. I'm going to skip any of the formal introductions because we don't have a lot of time, but honestly, these are the creme de la creme of people that are doing finance here. Finance and biogas is a big area. There's two main ways of looking at it. There's kind of the conventional finance, and then there's ITC, tax-based finance. So we're going to split this up, and we're first going to talk about some of the more conventional financing, then we're going to get into the tax-based. If there's questions at the end, just come up to the speaker here, because otherwise it's hard for everyone to be able to hear. All right, so John D. We have two Johns, so it's very confusing sometimes. But can you talk about what infrastructure investors like Generate look for in projects and for what you look for developers?
Sure. Hey, everyone, can you hear me? Great. Yes, yes. Hi, John Denan, Managing Director at Generate Capital. Just real quick, I've been involved in AD for about 8 years, investing in food waste since 2016 and dairy waste projects since 2019. I think the one, I'll take it back and make it super generic. I asked for the question to be about investors, to remind folks that there are different types of investors, and money is not just money. There are infrastructure investors who may want to buy projects and not necessarily corporates or developers, and they're going to look for, when they're looking at projects, they want contracts, they want stability, surety. So take a dairy project. They love the fact that there's a 20-year manure supply agreement. They love the fact that they can diligence the technology and it's all off the shelf and everything is proven before and the operations are diligenceable. They don't love the fact that the returns are based on revenues that are super volatile based on environmental credits, right? But that doesn't mean they wouldn't invest in that project or that type, but that's how an infrastructure investor thinks. And this is from the equity perspective, just to be clear. And then there's private equity investors. They're more likely to want to invest in a developer or a corporate. They want to invest in the projects too, but they're happy to take sort of both sides of the exposure, the corporate investment and the project investment. So keeping it super generic and high level, but I thought that would be a good place to kick it off, and happy to dive into details as we go through.
Thanks. All right, John with no H. So can you talk about some of the USDA programs and like BNI and REAP for RNG projects and how you work with developers on those?
Sure. Thank you. First of all, thanks everyone for sticking around and delaying your flights just to come hear us. So thank you for that. And thanks to the ABC for having us all up here. Pathward is a USDA lender focused heavily on the Rural Energy for America program and Business and Industrial program, where we leverage the 80% guarantee of primarily permanent debt. We can do construction with that guarantee, but it's a little bit time consuming and gets in the way of the timing of projects for the most part. But the program is designed around focusing on REAP, projects that are rural in nature, that are in MSAs under 50,000. The USDA just redid the map this past year. It's pretty easy to just take a project address and pop it into their website. I can help you with that if needed. So if a project is eligible, the bank underwrites the project to our underwriting standards. We structure the deal and follow all the way through to close and fund the transaction. And then we look to the USDA to provide that 80% guarantee on the backside. Why would you do that? It basically gives us an ability. It's not a credit replacement, it's a credit enhancement, and lets us do some things that we as a bank probably wouldn't do conventionally, whether it's term and AM, whether it's merchant offtake, which is primarily the big winner in this particular audience, and really creates a market of financing that otherwise would be much more conservative if you were to get a conventional bank to come in and finance a dairy project or a swine project. So we can lend up to $25 million under the REAP program. The Business and Industrial program is another $25 million that can be stacked to $50 million. So that really maxes out the size on your capital stack for the project. The CapEx, the uses budget would be CapEx, carried interest, transaction costs, contingencies, just a full loaded construction budget that we would put in place. And then for the perm loan, it would be, again, transaction costs, uh, an OPEX reserve, and a principal and interest reserve for the project that would be financed. So happy to talk to anyone about more detail. I think we'll get into some more details here in a little bit, but I'll pass the mic back to you.
Thanks. So Max, you used to be a banker, and now you work with developers, and you are one yourself. What advice would you give to developers when they're going to start the loan process to do an RNG deal?
Yeah, good question. I'll go with a couple of things. So, time is a key variable in these projects, right? It can help or kill a project. And I think a lot of folks I've seen over the years underestimate that, or don't necessarily go to the capital markets to source their financing, particularly at the right time. I see a lot of folks come too early when projects aren't really fully developed, and sometimes that can actually hurt counterintuitively to go in too early to an investment community, especially a bank. And while it does take time, especially with USDA, I think we'd like to see projects get a little further developed before they go out to the investor community. I'd also say consider your options. There's a lot of different ways to finance these projects now that didn't used to exist just a few years ago, which is really exciting. There's a lot of new capital that's entered the space very recently, a lot of excited investor appetite. So I would consider your options. Yeah, and work with good lenders who have done it before.
Great, thank you. So Paul, you're dealing with tax-exempt financing. Can you explain what that is and the key benefits for RNG developers, and then talk about maybe some risks such as offsets? We're going to talk about ITC later, but just give an overview and let's learn what tax-exempt financing does.
Sure. Thanks, Todd. So there's a little carve out in the IRS code, section 142, that allows private enterprise to issue tax exempt bonds to finance certain types of projects. And those projects in that code, generally it's defined as we are taking a waste product, whether it be agricultural, consumer driven, commercial driven. We're taking a waste product, a solid waste product, and converting it into something of value, whether that's through energy transition or recycling. And so with that code, we can issue tax-exempt debt to finance biogas projects. And I think the key benefits, if we're able to qualify and issue those tax-exempt bonds, is traditionally lower interest rates, because it's a tax-advantaged investment for our investor or our lender. So it's a tax-advantaged investment, and so their demand for yield or interest rates can be lower traditionally. So you've got traditionally lower interest rates, a longer tenor out to typically 10 to 20 years, non-recourse, and relatively flexible repayment terms. So I think those are the key benefits when you're looking at a tax-exempt financing. I think in terms of risks, I think I'll requalify that as maybe a couple characteristics that we need to be aware of. Particularly if we're qualified for an ITC, if we're going to receive ITC with our project, the federal government will allow us to double dip. So they'll allow us to receive the ITC and issue tax-exempt bonds. However, there's a 15% haircut on that ITC. So instead of a 30% project, it's going to be 15% of that 30, so we're back down to about 25.5% ITC. So that's one of the risks or characteristics we need to be aware of. And the second one is a volume cap limitation. So each state, I'm not going to go into detail, but each state is limited to the number of private activity bonds or solid waste revenue bonds we can issue based on their allocation, and we're limited by what their allocation is in each state. So that's a quick overview.
So as a follow-up to that, can you talk about the eligibility requirements?
Sure. So I touched on a little bit as far as being eligible for the project. We need to qualify. We need to qualify under that IRS code. And we typically we will always get a legal opinion from a specialized tax attorney to provide that opinion. They'll review the project, make sure that we're eligible. And the components that are eligible are anything related to the collection, the process, the distribution. So everything from trucks hauling manure to our digester, to our upgrade equipment, to our pipeline, to our tap, all qualifies for tax exempt financing. So typically in our biogas RNG projects, we're going to have plenty of costs that qualify. We'll have plenty of costs that qualify. Compare that to in the early 2000s when we used this exact section of the code for ethanol plants. Not much qualified compared to where we are today. The other key piece to qualify is that we need to get an inducement resolution in and approved by a sponsor, a tax exempt sponsor, such as a township, a city, a county, or a state agency. And that will preserve our ability to issue tax exempt bonds into the future up to 3 years. So.
Great. So when we were having our prep call, we got into a fascinating discussion about busted 351 deals. So Gary and John, you guys were deep into that. So can you talk about what is a busted 351 and how it would apply for financing a RNG project?
Sure. This is that's code speak. Busted 351. If you Google it, you'll actually, it's a real term. But the basic idea, and some of you, when we switch over to tax credit financing for these projects, because the ITC is based on the cost basis of the property, there's an inherent benefit if you can step up the, not just the cost to build, but the fair market value of the property. Traditionally, when credits were monetized through tax equity structures for solar projects, also in ITC, a step up was kind of always present because you had to form a special partnership with a tax equity investor, and you would sell the project down into that partnership. And so if it costs you $100 to build it, and the value of it once it was built before you turned it on was 125, you'd produce a credit based on 30% of 125 as opposed to 30% of 100. So what's that got to do with busted 351s? Just in general, the marketplace has sort of struggled to get to a similar step up to fair market value for the ITC when you don't have a third party investor investing in a partnership. So people call it like an internal transaction. You can't form one entity, just sell it to another entity and expect that you're going to get a step up when the same owners own the same two entities. There's circular cash flow. There's a bunch of specific tax rules that make that inherently risky. A busted 351 is a special transaction just structurally that allows you to set up a DevCo OpCo structure where the developer develops the projects and then transfers the projects to an OpCo. The OpCo is a corporation. And there's a couple reasons why you want it as a corporation. You can form the corporation in this busted 351 transaction and not circle cash. So it allows you to develop projects in a DevCo, transfer them to an OpCo, and get a step up, a higher value in the amount of the ITC. Secondly, and this is important, like structure just matters when you get into the world of the tax credit financing and selling these tax credits, is if the property is held in a corporation, you could sell your interest in the project during the 5-year recapture period, sell the stock of your corporation, and it's not going to cause a recapture of the credits. So very specific tax technical provisions, but the basic idea, just if you want to Google busted 351, you'll see it's a common term used in other sort of transaction structuring, and we're now seeing it quite a bit with the development of RNG projects.
So John, you were talking about this because you've got some deals that are using this. So how do you see this playing out?
I see it playing out in a very complicated way. So as a humble banker, we rely on guys like Gary to explain this. I had never heard of a 351 busted structure until recently with a client that's working with Gary. And and I think it brings out the point of whatever bank you're working with really needs to understand, at least to a certain level, the complexities involved on the tax piece of this, which is increasingly more and more important in terms of value to the project and the investor. And where we fit in is, one, we have to understand what the heck Gary's talking about on some level, and we need to feel that the customer's getting appropriate guidance and will get some sort of an opinion that validates it. Again, our lens is related to the debt, so it's really about the proceeds coming from the ITC and how that fits into right sizing the debt for the perm loan. And this whole transaction is taking place during the construction phase of the project, mechanical completion before, after. There's a couple different steps. So we're involved with entities that are tied into the collateral security of the project, pledges, movement from one entity to another that's got to be released at a specific time. It's pretty complicated. So, but it definitely works. It's the real deal, and we rely on guys like Gary to guide us through so that we can effect an appropriate forbearance agreement and release the appropriate entities at the right time, and add entities that are needed, and make sure that we don't go down a dark alley in our approval process as we're 2/3 of the way through construction at mechanical and trying to get the transaction done for the client.
All right, great. So speaking of complicated, let's get into tax financing here. So obviously the most important tax financing for this industry, for RNG, is Section 48, the ITC. So Gary, would you try to give a brief description of Section 48 and then why tax investors would actually invest in it?
Yeah, so as I mentioned earlier, solar was sort of the first energy credit. So as an investment tax credit, you determine what is eligible basis, and you actually start at 6%. Then you go to 30% if you meet prevailing wage and apprenticeship requirements, and then you can go to 40% if you meet domestic content, and you can go to 50% if it's in an energy community. So these are all things that were added in the IRA to make the ITC a little more complicated. But generally, no one is going to do an RNG project beginning in 2023 all the way through 2028. If projects start construction by the end of this year, those projects should qualify for the ITC. And then it's just a matter of what parts of the project qualify. We had proposed regs that came out, which, our ABC and others commented on, and the government's still working on final regulations. But the bottom line of those regulations was that your digester, all your gas upgrading equipment should qualify. I won't go into all the specifics why, but the market is transacting on the basis that the entirety of that portion will qualify. And then typically you'll get a cost segregation study, like a third-party advisor will look at the cost buildup of the project and say 95% of it is ITC eligible. Why that's important: if you're going to sell the tax credits, like many developers don't have the utility to use the credits against their own book, the IRA added provisions which allow you to sell the tax credits. The buyers step into the shoes of the seller as the taxpayer of record that had generated the credit. So they're the ones that basically are relying on your documentation for the eligibility of the credit. And they'll pay. I mean, the market still to this day is somewhere in the range of 90 to 96 cents broadly for tax credits. Now, I see RNG ITC selling for 92, 94 cents. I haven't really seen, like, PTCs are just considered a little less risky. So those seem to trade at a higher amount. That's important for the developer because that's cash, just a cash flow generated once you place the project in service. It's just an additional cash flow to increase your return on investment.
Thanks. So speaking about buyers and all that, Max, who are you seeing as the buyers in the ITC credit market? And then what does that deal flow look like?
Yeah, sure. So we didn't really do formal introductions, just a quick aside. So Varentis is primarily a sell-side advisor. We also represent some buyers in the market. Our team has been working on monetizing tax credits for biogas in particular, really since 2008, since the Recovery Act, and then again through this next evolution we've had recently through IRA. We've been sell-side rep on about $70 million worth of QBP transfers in the last 6 months. another 100 million or so. Hopefully we'll close this summer under term sheet, and then quite a bit more than that coming. And I think the folks on this stage can add significantly to that. So the deal flow is very high. We're seeing really nice response from the market. I'd say buyer composition, corporations, they're looking to mitigate tax liability. They typically have advisors that help with their accounting to represent them. But we're seeing a lot of corporations in particular, all kinds of different industries, so relatively agnostic. We're seeing some financial institutions, so banks and insurance companies. They've historically been some of the primary buyers of these credits through traditional tax equity structures. So we're seeing a lot of new entrants, and I think the intent of the law is really working. I think we're seeing a whole new broad, much broader pool of eligible candidates and buyers come to the market, and it's been really exciting. I think we had some concerns about their perception of biogas as potentially a riskier asset class. And I think we're actually seeing parity quickly happening in the pricing. A lot of that thanks to certain insurance policies that you can get to indemnify those buyers because they take a lot of the risk on sizing and overall eligibility. But we're really excited, to Gary's point, we are seeing that kind of similar pricing in the low 90-cent range, which has been really good for this industry. We're seeing that really add to the acceleration of the growth.
Terrific. So John with no age, we're talking a lot about ITC. We've talked about some of the timing for that. You've mentioned ITC bridge loans before as a way to help fund that gap. Can you talk about how that works, what the pricing looks like, and how much you can get and how it would help a developer?
Sure. What Max said, I think the key is, those of us that have been in the space for a while, dating back to solar, the tax market was primarily P-flips and inverted leases. And the IRA unlocked a whole new world with the transfer option. And a lot of folks that did not like the complexity or CFOs trying to sell to their board a P-flip structure where they're an investor in a project, now have the ability to basically buy a commodity of a tax credit. So we shouldn't lose the sight of that whole new market. And part of the reason it's opened up is because of I don't want to say ease of transacting, because there's still a lot of complexities to it, but the transfer market is really what's, I think, driving a lot of that. As far as an ITC bridge loan, so we would start with our traditional construction loan that is to be taken out by a permanent loan. So the two are correlated based off of the pro formas of the transaction, and we would lend, let's just say 75% loan to cost on that uses budget, which would be fully loaded. That would be carried interest and transaction costs during construction, contingency, the CapEx, just make sure that we have everything included in there to get the project from close to commissioning. So loan to cost of 75% leaves 25% of equity that would be typically going into the project first, and then we lend the other 75%. The ITC brings the opportunity to increase that leverage point based off of the projected or future value that is calculated for the ITC. And that's a formula that's pretty straightforward, but also still kind of gray. And that's going to be your eligible costs that were referenced. What is the ITC percentage you're expecting, 30, 40, or 50, which you need to kind of validate, right? So you can't just say you're going to get a 30% ITC. You've got to be able to show that you're going to get from the 5 to the 30 by prevailing wage and apprenticeship, and that you can demonstrate you're going to get there with that. And then whatever that number is, there's going to be an assumed purchase price in the market. Let's just stay with the transfer market and say it's 90 cents, kind of pick the middle ground for an RNG project. That net number, then we would look at and say, okay, on a formula basis, we'll lend 75% of that. And this is broadly just our general look at that. So that interestingly fits nicely between that 75% loan to cost for the construction loan and our absolute minimum equity requirement, which is 10%. So that will let you get up to a 90% leverage position in the transaction with that ITC bridge loan that we just went through the calculation on. Now, interestingly, as we close a construction loan, the ITC in this transfer market generally is not locked up. You don't have your purchase agreement in place. You may not have your structure in place. You're still talking to Gary about what is a 351? Do we do a 351? Who's my other investor going to be? What's my step up look like? Who are my potential buyers? What will they want in terms of structure and all that? So when we close a construction loan, we'll close the concept of an ITC bridge, but it'll have CPs that will require that to be locked up later in the deal. But from a banker's perspective, when I close construction loan, that's basically deferred equity and it's not locked yet. And you could get through construction, exhaust your construction loan, still have 25% of your project to finish and not have your ITC committed. So it's an air ball, right? So from our perspective, the way we look at the ITC bridge is we can size it, we can document it, we can put it in place to a CP, but we're still looking for a corporate or a holdco support in some way. And that could be a corporate balance sheet guarantee from your investor. It could be a letter of credit. It could be an equity commitment letter. Just some way to feel that there's assurance that money will be there in one way, shape, or form to finish the project. Because until you finish the project, the ITCs were zero and the projects were zero because it's not commissioned yet. So I'll stop there. There's other nuances and complexities, but those are the typical things that we're looking at and how we structure an ITC bridge loan.
Tax financing could be more complicated. Wow. That's an interesting world. So John with an H. So on our prep call, you gave an interesting stat that I wasn't aware of, that Generate has done 50% of the existing ITC biogas versus RNG deals. And Gary and I realized, you pointed out that Gary and I had a client that did the other one. So there's been two. So I can say 50%. So that's pretty damn good. So you've done ITC before the IRA, and now you're looking at it now. So what has changed in your view, and then how do you evaluate these deals?
Yeah, no, great. And maybe, the pre-IRA paradigm, as Gary was talking about, pretty complicated, pretty much open to traditional renewables only. It's probably worth explaining why, right? Todd and I are talking about two food waste deals where the project self-sheltered the tax, but didn't have access to buyers because buyers didn't understand the technology. This was 2017, 2018 timeframe, right? So a long time before the IRA and the new stuff. Look, the perception, Max talked about it. The perception was this wasn't a industry where buyers pay for the tax benefits and put the structure in place because know these projects would be operating in 5 years. They didn't know what the technology was, right? So there's not just the IRA that's made the change, right? It's actually the fact that the dairy RNG industry has boomed and there's now hundreds of projects where there were like zero or like less than 10 in 2018, right? So it's not just about the tax code. But what has changed? What are we excited about? What's really different? So one, the industry is more mature. Buyers have the perception that they can actually do this, and it is less complex. These credits are now transferable. So there are other cool structures coming out, as Max and John have talked, and we'll talk more about. I think there's more cool stuff. But in its simplest form, you can, there's still a lot of complicated work to actually be eligible, qualify, get the credit, but it's just simply transferable. You don't need a special partnership with all of the different bells and whistles that go with it. You can just sell these credits effectively, right? They're not tokens, but you can sell them. That is a massive simplification compared to previously. So that's another. Unlock one is the industry is taken seriously by buyers. Unlock two is it's now easier to transact. You can still do more complex transactions to get more value out of it, right? But that's, they're sort of the big two unlocks. We're talking a lot about structure and technicality. I do want to step back for a moment, keep it high level and level set. ITC does not make a project work. Project needs to have revenues that make the project work to start with. I just want to make sure folks are staying in reality with this conversation. This is a phenomenal incentive for our community, but it's not going to make a project work necessarily. A project that's on the borderline of working, it will help make it work. There are other factors, the revenue forecasts, volatility of the revenues right now, that they're also things that you have to consider. So I just want to make sure we're not, the folks are remembering that and don't take away the wrong message.
Yeah, I think that often gets lost when we're talking any kind of government incentives. And there's a lot of industries. I started working with ethanol, and believe me, ethanol started living in a world where it was almost all driven by incentives. And they've suffered as a result from that. Paul, can you talk a little bit more about that 15% reduction? And then how many of your deals are still using ITC? And then how do they kind of do the evaluation about whether it's really worth it to do the tax exempt financing? Just kind of take us through that process.
Yeah, well, so the projects that we're involved with, certainly they've made the determination on their own through their cash flow analysis that the spread difference between other debt financing options that they're considering versus what they might be able to get with a tax exempt bond, that spread difference, for instance, on the projects that we're working on, we can do either fixed or variable, and the fixed rate today is anywhere in the mid 7s to low 8s, and that's fixed long term. On the variable rate financing, the all-in is probably a high 5, low 6. So they'll use that analysis, compare that in their cash flow with the haircut. And on a PV basis, the projects that we're involved in, it's an advantage for them to issue the tax exempt debt and take the haircut on the ITC.
So, Gary, this is obviously very complicated, and having worked with you, I know it's very complicated. So for a developer, what do you see as the biggest stumbling blocks to be able to get ITC tax financing and prove up the credit? We were just talking about domestic content with the new rules, but we could spend an hour just on this. But what are the big ones, like big three?
Yeah, so, I mean, originally everyone was concerned when the government first came out with proposed regs and said that gas upgrading equipment, they called into question whether gas upgrading equipment was qualified, which was a shock to all of us. I remember when the day the reg came out. I mean, and I know some of the people that are writing the regs. I sent them a note. I'm like, what did you just do? Did you read the statute? But we finally got some of that fixed. So I still see, and this is why at the hearing in Washington on the proposed regs, it was dominated by the RNG industry, like that day. And it was about the owners. There's some ownership limitations that are put into those regulations. So I see that as like one of the biggest obstacles. There's this notion that you have to have full ownership of the unit of energy property. Like that's the definition. You can't have two different parties own the unit of energy property or no one gets the credit. So there's still some gray kind of unanswered questions with respect to biogas, because when the government wrote the proposed regs, they're writing them for wind, solar, hydro, everything else. And, just biogas is the relative new credit on the block. So that's an issue, is just to make sure the ownership limitations are in place. And then the other item that is probably my number one thing working with developers in the space is, what John was mentioning, it's either a 6% credit or a 30% credit. No one's going to do a project for a 6% credit. It's going to always be 30%. Most of the projects that have been placed in service thus far were grandfathered. If you started construction for January 29, 2023, you get the full 30% credit. You don't have to worry about prevailing wage and apprenticeship. That's Davis-Bacon-like rules, very complex set of proposed regs, a lot of compliance costs just to document that you're complying with those requirements. So fast forward now, we're starting to see projects that aren't grandfathered out of the PWA requirements. So this has been a challenge, not just, for RNG admittedly, but it's a challenge for the other renewable energy technologies as well. And then I'm going to give you one tax takeaway. Like, this is trap for the unwary, and I've talked to numerous RNG developers about this, and almost none of them are aware of this. So write this down. Even if you started construction on your project before January 29, 2023, and you're exempt from PWA for purposes of the ITC, great. But if that project's not placed in service by the end of calendar 2024, you're subject to PWA for 45Z credits. So really important, like, I mean, I think that plane has flown way over many of our clients, and that's something that we've had several developers that have those projects. They're going to rush to try to get them done in 2024 because they don't want to deal with the PWA requirements for 45Z.
Yeah, and we're going to talk about some of the alphabet soup of other credits in just a little bit here. But so, John with an H, you were talking about transferability, but so Max and John with no H, we got to find you guys nicknames that I can use here. This is killing me. But so Max and John, when you guys are out marketing these things, how are you seeing tax credit transferability impacting this versus the traditional structures, partnership flips and all of that?
Yeah, so John gave a great overview of how you all are doing bridge loans. We're seeing that structure generally accepted now. We're also seeing some lenders who are trying to create a new product, which is basically just a bridge loan against the liquidity and value of the credit itself, right? So we're starting to see that emerge, which I think is really exciting for this space. So that'll help a lot of developers be able to pull that money forward and bridge to what eventually will become a transfer. And that's brand new for this industry. There have been other regimes historically, like 1603, where a tax credit, like a quasi credit, was available, and those deals got funded different ways. But we're starting to see more of a traditional kind of project finance renewable energy paradigm get adopted here in biogas. Some deals are pursuing flip structures. We're seeing some partnership flips and also some sort of new transfer flips, the industry is starting to call it, where you still transfer the asset into a new holdco to get the step up in basis, but then you end up transferring the credit to a different third party. So we're starting to see that structure get adopted, and we'll see some deals close this year who are going to do that. But again, I'm seeing more appetite for this concept of a bridge loan, potentially, not yet, but potentially against 45Z if we get a little more guidance here in the next few months about how that formula and the carbon value will be counted. But we're going to watch that evolve here over the next couple of months.
The only thing that I would add is it seems that, so in the P-flip world, there are a lot of syndicators where you might have investors coming into a big fund or looking at multiple projects. And maybe it's just inherent because it's biogas and each project is somewhat bespoke, but it's the projects that I've seen have had one buyer of the credits. They're going to come and buy all the credits for a particular project, or they want to come in and buy all the credits for 4 projects with a developer over the next 2 years. And so you're negotiating in a very direct bilateral way with one investor. And that kind of makes sense because the transaction structures and the timing and all the evidence that's got to be put in place and the requirements for recapture risk and all of that are, be difficult to satisfy multiple investors or buyers, I should say, for the transfer. And so I think a lot of kind of actions when you go to the market, you're going to get one buyer for those credits, more than likely. And that's kind of a generalization, but that's what I've been seeing.
So somebody briefly mentioned tax credit insurance. So can anyone, I don't care, a few of you want to take it, talk a little bit about what it does, who it's supposed to help, and then why it's being utilized in pretty much all these deals.
Well, I'll give my 2 cents. I mean, I do see tax credit insurance quite a bit. Spoke with many of the insurance providers, if any of them are in the room, and pretty flexible. The way they'll decide to cover what risks you want to cover with insurance. Oftentimes, you don't need bottom dollar insurance. Like an RNG plant was built, it's there, it qualifies for a credit. Perhaps the buyer is more concerned about the risks associated with your documentation under PWA for the 30% versus the 6% credit. And there's actually a provision, the way those rules are written, if the government comes in and discovers that you don't have adequate documentation, or you missed something, then you can actually pay your way out with a penalty. And that costs the project money. So those are the types of things that I'm seeing the insurance market come in and support. But again, I don't see it. I see it not one size fits all. The insurers will do it. It costs money to do it, but it's very helpful to buyers because the buyers, they're not experts on these tax credit rules, and they have a lot greater confidence when they know an indemnity provided by the seller of the tax credits to the buyer is backstopped by an insurance policy.
To add on to that, I think that's been the key that we've observed. I think all of the deals that we've closed in the last couple of months have had indemnification insurance. So to your question, who does it protect? It protects the buyer. What can it cover? It's actually quite a variety of different things. It's the binary risks, am I eligible or not? It's the sizing risk, did I claim the right amount of credit or not? And then a couple of other things that it can cover on deals that are trying to get creative with step up in basis, right? Am I claiming a reasonable step up in basis, and how did I get there? So it's a really powerful tool, and I think that's, again, what's allowing this pricing parity that we're seeing to get gross credit sales in the low 90s for RNG projects, which is really exciting. So I think it's a really important tool, and we're seeing quite a few different insurers enter the space. So the big brokerage houses are working with a lot of different actual providers, and we're seeing a lot of them come to the table and get excited about this.
I would add that the cost of the insurance is greatly beneficial in some ways to the seller, because the buyer of those credits is ultimately going to look back on the seller for any indemnification, whether there's insurance or not. So the insurance basically defrays some of that risk and protects the seller of those credits. And if you have a corporate investor, they're not going to get put up their balance sheet or indemnify the buyer of those credits for any future recapture risk. So it's a way to give comfort to the buyer of those credits that their needs will be met should something happen with the IRS. I think that's pretty important. The other thing is the value of the credits. What is going to be paid for those credits is driven somewhat based off of the perceived risk of the transaction. So even though you might pay 3% or something like that, you're going to get a lower discount to par on what you get for your credits because you have that protection. And I've not seen or heard of a deal get done without it. So I mean, it's pretty much a necessary evil.
I've seen it for other PTCs, but yeah, for RNG, it's an important element.
So are the ITCs for RNG going to get extended? You're prognosticating, so take this with a grain of salt.
I mean, this is somewhat of a difficult question.
That's why I ask it. I can't give you guys softballs all the time.
Well, so just be aware, so the RNG ITC is sitting in section 48 of the code. And you have this ability by the end of this year to safe harbor the next 4 years of projects all the way out to 2008, but you've got to safe harbor those projects this year. And this is not the first time this has been done. This has been done in wind, solar. I'll give you an example in wind. Wind developers would go out and contract for transformers. Transformers are a relatively inexpensive item when you're building a wind farm. They would buy 20 transformers, and then over the next 4 years, if they built 20 wind farms, all those wind farms qualify, even if they didn't have development yet very far advanced on those projects. So first thing is you can extend the 48 credit yourself by taking actions this year. The second thing is after this year, the section 48 credit sunsets, and we have the new technology neutral 48 cap E credit. RNG is not part of the 48 cap E credit. So it's sort of standing alone, asking for an extension of the ITC vis-a-vis solar, wind, all the other technologies that have benefited. So that makes it a more difficult ask in Congress to try to get an extension of the section 48 credit. So, if we were with every other technology, I've lived this. I've lived extensions, expirations for 2 decades. Like yeah, it'll get extended eventually, but I'm a little less bullish on that. I'm definitely more bullish on, I know we're waiting for 45Z guidance, but 45Z will expire and it's going to apply to a much broader industry, like not just RNG, all the clean fuels, and all the other tech neutral credits go all the way to the late 2030s, at least through 2033. So 45Z, I think, has a much greater likelihood of extension, but that's, again, who wins the election, what's the makeup in Congress, all those things really matter.
Nobody else wants to? Oh, there's Paul. All right.
Well, I was just going to add that if anyone is considering tax-exempt debt financing and you're going to try and safe harbor for projects in the future, you can use tax-exempt financing to recapitalize your project in the future. I mentioned that inducement resolution we need to get into place. We get that in place and we're preserved to reimburse ourselves or recapitalize ourselves for up to about 3 years. So that's just a step that if you're considering that, that you'd want to get in place to preserve your ability to come back and recapitalize in the future with your debt and take out any of that equity that you put into the project.
Yeah, maybe it goes without saying, but for the developers in the room, what you're hearing is don't put extensions into your model, right? No one's going to give you credit for it until it happens because it's massively uncertain, sadly. What's next if not? Who knows? There could be something better, right? Like TBD.
Well, you're on the board of ABC. So what is ABC doing, as far as working on that?
I was going to save that for my what to do in 10 seconds at the end. No, look, the ABC is obviously active in all the right regulatory engagement and things. And this might bleed into some of the questions about Z and V. Maybe lay the scene for everyone. We're talking a lot about the ITC because it's done and it's active and it's transacting and it's in law, right? So we can talk about it. We can't talk about the V the same way because the guidance hasn't come out. We can't talk about the Z the same way because the guidance hasn't come out. Because it's taken longer and we're in 24, we're in an election year. If the guidance doesn't come out by a certain point in time, it is subject to revocability. There's a fancy name for it. That's not the right name. But if there's a change in government, new government can revoke those things. If they haven't happened and there's a change in government, new government can stop those things from happening or slow them down dramatically. So there's just a lot of uncertainty as to some of these drivers. And so the what happens next, and unknown. It could be same government stays in place and doubles down on these things, extends them, does longer, right? It's anything is open, but for now you can only underwrite to what is known. That would be the quick takeaway.
All right, well, we've talked a lot about Section 48 ITC, so let's talk about Z and Q. One of the things that I've always been fascinated by is, you can't stack Z and Q, but who is U? And there's a lot of people that are independently developing carbon capture that would add on to RNG facilities, and they're trying to take Q while the RNG facility is going to try to take Z. So I don't know that there's a really clear solution in the code or in any of the regulations, certainly with Z's regs not out. But anyone want to give some free advice? Not binding, but some thoughts, maybe is the better word to say it, about whether you can do both, and what are some thoughts about how to do it?
Well, I'll start. I mean, it's pretty simple when you open the code and you actually read the words. And this is in 45Z. It tells you that if you have a facility you're getting the 45Q credit on, it's not a facility you can get 45Z on. So that's the statute. So there's already a no double dip rule in the statute, but the next question goes, define the facility. So this is an area that the government has addressed in other areas of the IRA. namely alphabet soup. There's the 45X credit with the 48 Cap C credit. Those are manufacturing facilities. You have a similar no double dip rule. The government wrote specific guidance that allowed you to draw lines between where one facility starts and one facility stops. So the logical next step when guidance comes out on 45Z is the government will be, and commenters will ask for further clarity on how we draw the lines between one facility or another facility, and that will shed light on what you can do to self-help yourself to qualify for both credits.
Do you think you'll be able to? Come on, we got to give an answer here.
I'm going to wait till we actually see what guidance comes out. And I suspect usually the answer is not clear enough for anyone to transact on that basis. And then we're going to ask for more clarity, is my guess.
So let's talk about 45Z financing. I mean, it hasn't come around yet, but it's certainly a very powerful tax tool. So how are people seeing companies get ready to be able to monetize that? And then what does the tax credit market look like if somebody wants to be able to transfer that, or are people going to use it themselves?
Well, I'll say I think it's exciting to note that it's arguably one of the first pieces of legislation in our industry that is carbon intensity or intended to be carbon intensity based. That's really exciting, especially for our industry for clean fuels. So that's really important to note. How is it going to be tied to carbon intensity? We don't know. And what is that carbon accounting methodology going to look like? We're not sure yet, and we need to know pretty soon. So I think ABC is doing a good job getting into DC and trying to understand what conversations are being had, what intergovernmental agencies are trying to influence that carbon tool, and how we might be able to give some advice. And as far as the industry's reaction, we are starting to see companies shift gears. I think, between 48 and 45Z, how they can monetize that, how they can pull that value forward, right? We were talking about that earlier. And we are seeing the financial industry kind of waiting on standby and ready to transact and try to bridge against some of that value for existing projects. There's no recapture risk, right? It's fundamentally different. And so I think you'll see some developers that have balance sheets self-claim some of those. I think a lot of them will get transferred because the cash value is just so rich and the NPV of that's really important. And if we can borrow against it, then I think that's really exciting. I think that could be much larger.
Yeah, to maybe put that into context, right? I mean, this is on production over 3 years, 26, 7, 8, or 25, 6, 7? 5, 6, 7. Monetized 26, 7, 8. And on like your full fleet of assets, right? So if you can pull forward 3 years worth of all these revenues in a debt facility, that pays for all the next projects you build, right? Or a very large portion of it. So this is a massive program, and it is super exciting. It is fingers crossed, the first CI-based piece of legislation, and so that will play really well for our low CI and ultra low CI products, right? In this industry. But again, we got to do the regulatory engagement and all the work to make it get legislated in any political paradigm, right? This part of the story here is that the product we're making is appealing to both sides of the aisle. So we've got to be an industry that works with that.
So I'll just add on 45Z, because it's a production tax credit, it's got great potential for a higher value for the credit versus an investment tax credit, which the market perceives as just, a couple cents riskier. So the big thing, obviously, we're waiting for is the guidance on how you compute the credit. Negative CI scores, just the exact GREET model. How are we going to, it's impossible now. People take conservative points of view on putting a number on what the value is. But once that value is established, and assuming the rules will be, and they should be, once you figure out how to compute the credit, it's like any other production credit. Did you produce it? Did you sell it? And what's the value? What's the volume? That's pretty easy to diligence. And that will open the opportunities like others have mentioned to couple both the ITC and the PTC for a period of time. And that's really exciting because the buyers of the tax credits, when I talk to Deloitte's clients who are the buyers of the tax credits, I've had 2 conversations in the last week. I don't know how many times I go in and it's a Fortune 500 company and they look me right in the eye and they say, yeah, I want to buy $1 billion of tax credits this year. And they're like, what? And they don't, all they know is wind and solar. They don't know anything else. I always bring up renewable natural gas because I see the opportunity for an investor to get the ITCs and the PTCs for at least a 3-year period, possibly longer. And especially for a developer who has a portfolio of 5, 10, 15 projects. You may not get to $1 billion, but you're going to make a dent in $1 billion. So that's really exciting.
I think the only thing I didn't hear, you inferred it, or implied it, 2027 is the end of the 45Z right now. It's 25, 26, 27. And we're looking at that as some modest assumption of value. As was indicated, it's not really fully clear cut. We've kind of pulled and took some estimates on what we put into our pro formas, and then we go to 0 in 2028 thereafter, because it's just, there's nothing on the board right now for that to get extended. Even though we think it may, there's nothing legit.
So I'm going to ask people if they have questions, come on up. We're all friendly. Mark, you can stand up at the microphone and ask your question.
So I've got a comment and a question. Mark Reedy at Kilpatrick Townsend. So the comment is on the, there is a clear path on the lack of stacking, and it would be to take the alternative fuels credit for this industry through the end of this year, or BTCs for the other biofuels, or for the SAF under 40B. Then you take the clean fuel production credit through the end of 27. Then you take the hydrogen credit, if you can take it, through the end of 38. And then you take the last 2 years of the 12 years on the 45Q through 2040. Well, that's going to work great if you got biomass as a feedstock. So that's my comment. My question is, because a lot of discussion here on using tax credits as collateral for bridge loans. So there's a short play and a long play on this. On the short play, when you're structuring these transactions, so like a Max or John, if you're putting these together as a lender, are you can only transfer tax title once. So are you going to buy those credits at the end, or once the construction loan comes in and pays back the bridge loan, will you act as a marriage broker to then find a buyer for those credits, or will they go back to the developer who will then find a way to monetize?
So what we're doing as a sell side, primarily a sell side advisor, Mark, is we have relationships with bridge lenders who will take some sort of collateral position in the project subordinated to the senior debt with a carve out on the tax credit. So they have a security interest in the cash value of the credit itself, but they are still taking construction risk. So it is, by all terms and purposes, a construction loan that's typically made to a holding company down to the project, which serves, as John said, as deferred equity, basically, collateralized against the value of the tax credit. So they're taking that construction risk. Once the credit gets generated, we have documented that we will broker that transaction and sell that credit on behalf of the project company, and the cash immediately goes to retiring the bridge facility. If there's anything left over, which sometimes there might be, then that goes into the waterfall and the senior lender can figure out what to do with it.
So our perspective is the exact opposite. We're coming in at the project level, lending to the LLC, all the entitlements that are going to deliver a project that operates, that will generate cash flow and repay a permanent loan. As far as the ITC goes, that's incremental. And we're looking at it, just in a pure, clear way, a 75% loan to cost. We would want 25% equity into the deal up front. Any ITC that we would do would be incremental to that. overlaid in security with the whole project so that we can help and have influence in and a seat at the table to make sure that the project gets delivered and that binary risk of you have a credit or you don't is resolved so that the credit gets repaid. We would not come in as a bank and just do an ITC bridge where we wouldn't have control of the project. The risk profile for a commercial bank, that just doesn't work. That's where Max will come in, and he's got investors that are looking for a higher yield. They're coming in maybe at a holdco. Well, I think they are coming in at the holdco level. And while they want the rights to the ITC, which is really kind of gray until it is, right? Until it's real. They don't have any control of the project itself. They don't have control of getting the project completed. So they're taking definitely higher risk because they don't have project level control of the construction and getting the project turned on.
Last thing on that for Mark is just there are ways to structure debt and or equity together to accomplish both bridging the ITC and potentially a step up in basis. And so those transactions are just now starting to happen.
So we're almost out of time. So I'm going to ask the last question for everyone here and just go down the line. What advice would you give to developers seeking financing in today's market, whether it's tax credit, equity, traditional debt, tax exempt? What's like the one thing you would want some developer to know?
I kind of answered this early, which is, time, but also have realistic expectations. I think, John, you said that. Like we still see pro formas with $150 metric ton LCFS prices today. Banks aren't thinking that way. RINs aren't going to be $3 plus forever. There's an intrinsic value for the carbon in this market. I think there always will be. I think investors understand that, but I encourage folks to have realistic expectations and just canvass the market. There's a lot of really good opportunities available today to fund projects.
Yeah, mine is a slight corollary, but you got to pay attention to all this. There's all these balls in the air. We didn't even talk about the LCFS rulemaking today, which is driving equity for the near term. There's a panel on that this afternoon. That's why we didn't talk about it. Plug. But no, you got to pay attention to all this because even the stuff that is legislated is really technical, and you actually have to go through all that to get access to it. And then the other things, the Qs, the Zs, the Vs. Sometimes it feels completely unrelatable. This is where the ABC can help you. Stay tuned to the ABC. They are putting out frequent materials on this. They are calling for sign-ups and whatnot at the right time. This is what they are doing and where they are engaged. As a developer, you don't have to do it yourself. You can do it through the ABC. So the key thing is you actually have to pay attention to all of this stuff because it is all moving. And it drives all of those types of financings.
I'll just, because I'm the tax advisor up here, I'm going to stick with tax, but because it's such a valuable, we've got the alphabet soup of credits. I just think it's incredibly important for companies to step back before they, your portfolio of projects as developers and really think strategically about the alphabet soup of credits and your organizational structure. Like that's hugely important. So this sounds very self-serving, but I think it's critically important that you have a really good tax advisor that works with you because it's not just about my law firm's going to negotiate a purchase and sale agreement. Good luck, because you need way more than that to really understand these credits.
So I think Pathward is a really solid lender in the space. We have a great team. We're creative and thoughtful in how we try to work with our developer clients. The best advice I can give, my biggest competition is equity. I don't really view other lenders as true competition just because I think we're the best in what we do. But my biggest competition is equity as an alternative to our debt financing and the cost and what we can deliver. But that's also something that I feel is the biggest requirement for a developer. And I'll steer a lot of developers to potential equity parties and want them to have their equity partner lined up, whether it's at the project level or a holdco platform level. The equity is really important because they're going to drive the tax conversation in large part. They're going to drive, are you going to do it merchant? Do they want fixed offtake? They're going to drive a lot of the technical requirements for the design. they're going to front the money early on before you NTP and allow me to come in and actually have a cost budget that makes sense and isn't speculative, that's kind of locked in. So I would say you got to start with the equity. You can develop a project all the way through and not have your equity partner, and you're really going nowhere, because one, you need them, and two, you don't know what you don't know with the next turn of the page, and the equity is going to be your solution to help get you to the finish line.
I think I would just add that, it takes time to put together a sound project financing that's going to work and be successful. So involve your finance folks early on in the process. I can speak for myself. I mean, we're success based, so it doesn't cost you a dime more to hire us and get us involved early on in the process. And I think that probably goes for most of the people here. So start early and help, have those people brainstorm with you as you're putting together your finance options.
Well, thank you all so much. Please join me in thanking the panel here. This has been really good. All right, we're done. Thanks, everyone.